Welcome, folks, to this second session dealing with managing VAT in large corporates. You may recall that in the previous session we highlighted two specific issues. The one is Stephen Covey's the main thing is to keep the main thing the main thing. The other one is understand your default position. Now, to do both of those things, we need to understand the risks that we're involved with. So if there is no risk in what you're doing for the organization and you're sitting there just getting a salary, then it means that you're not adding value to that organization, and the shareholders won't like that. And I guess nobody wants to be in that position where you do not add value to the organization. So in this session, we are going to start looking at how do you identify risks, and in the next session, we'll start looking at how do you measure those risks. So let's get started. Now, I appreciate that these slides are very busy, but they do summarize the intricacies and how you bring functions together within organizations quite well. So let's bear with me for a little bit. So if you look at the group strategy, which we talked about last time, you get operational strategy and corporate strategy, but those must be aligned, otherwise you're going nowhere. And if you then look at the VAT strategy, often that is de-linked, as we've said before, from the operational strategy. It's almost just seen as something that must happen by itself. It doesn't. That alignment is critical. If you then look at the corporate strategy, often we find there isn't a tax strategy, but there should be a tax strategy at the corporate level, and that tax strategy should be split between indirect tax and corporate tax, because those are two completely different things. Then if you then look at the indirect tax strategy, there should be a VAT strategy and a custom strategy, because those are the two main components. Now, if you do not import anything ever or export anything, you won't have a customs and excise strategy, because that doesn't make any sense. Why put effort or waste effort where it isn't needed? But if it is an organization that imports and exports, absolutely, you need to have that. And then a VAT strategy that might entail a number of things. So this is like the minimum that you need to consider in a major corporate. If we then look at the organizational compliance framework, we've touched on that in the previous video as well, but it starts with a formal tax strategy, a formal tax policies, and formal tax procedures. Now, as we've said before, that sounds like a typical CA thing, that where everything has to fit into a box, but unfortunately it has to be for those strategies to work together in mediating and addressing the risks in the organization. So what are those, and what are the operational imperatives then? Clear lines of accountability, clear lines of responsibility, empowerment, oversee functions, and communication, as we've mentioned before. That should be built into the strategies to make certain that the strategies are executable. And then once you've done all of that, then you go into the level of compliance. So if that gives you, if everything is built appropriately, you should have the first levels of compliance. And that is alignment between the strategies and the operations, the documentation that you can fall back on. When somebody says, but I don't know about this policy, where does this come from? Well, there it is in policy item 15AB, Roman 3, Chapter 7 of Volume 3 of the policy book. There, you should have known about that. Documentation and then the audit trail. Every transaction should have an audit trail, because corruption happens where there's chaos, and audit trail cannot be followed. So the moment you see a lot of chaos in an organization, be very, very careful. That is a breeding ground for corruption and hiding stuff. And then monitoring. So that is second tier, but this first tier information that is generated is worth nothing if it's not monitored. And today you get wonderful automated systems that can monitor data for you and provide you with early warning little red flags. if something does not appear to be what it should be. And then we analyze all of that or summarize all of that in this slide. You got your organizational vision, organizational mission, and your organizational strategy. And those are the three pillars that drive your organization. If you have certain values, but the strategy undermines that completely, then the value is worth nothing. As a simple example, if our strategy is, or our vision is full compliance and absolute openness, transparency with SARS, but then at the same time we have this boardroom discussions, but how will SARS ever pick this up? That means the value is worth nothing. And if you cannot align the value system with the operations and the strategy, the business is beginning already on a downward spiral there. And all of that then comes into a tax strategy. So what are the potential sources of risk? And this is what we'll talk about just now at a very high level, but we'll talk about that just now to unpack it a little bit more. So at the first is tax operations and risks. So what inherent risks are in the operations? And keep in mind the original questions that we've asked. The question that we asked, do you understand the default position? And that default position will tell you, is there any risk there at all? And tax accounting and reporting, what information flows through. See how it all ties back to what we said before about information. Tax compliance, how is that done? What is your philosophy about compliance, and so forth and so on. Automatic and technology integration. How much technology do you want to use? In very complicated systems, in banking systems, for example, you absolutely can't get by without technology. But also in normal businesses nowadays, the volumes of transactions is just so voluminous and huge. Large data is a term we all use, but we don't always understand the impact of that. Is the information that we're getting from the systems, to a large extent, it should be automated as much as we can. And then organization and resources. And we're going to talk about that, when we go into this a bit further in future sessions. But what should a tax manager be able to do? And it doesn't mean because a tax manager is very technically inclined, he or she is not appropriate for the job. It probably only means the person is only appropriate for a certain measure of that job, and you have to build capacity around that person to fulfill the other requirements. But normally one person can't do it all. That is as simple as it is. Then we look at the risks, and we'll talk about that a little bit in a little bit more detail just now. But at a high level, they are insight risks, analysis risks, and follow-up risks. And if you understand those risks, then it's easy to then say, but where do they fit into my organization, and how can I mediate that? So let's just have a look at the sources of that risk. Insight risk is you see but you don't see. You don't have the insight to understand this true nature of the risk. And this comes with, not because you're so stupid or I'm so stupid, it comes with an environment which is increasingly getting more complicated and more integrated. And sometimes we don't fully appreciate, or we're just so overwhelmed with the magnitude of information flowing at us that you just don't really appreciate. You don't have the insight to understand what the risks are, and all you really do is focus on to get the day-to-day stuff out. There's no apparent answer for that except keep on training, keep on talking to the right people. Don't get lost in a corporate environment where you sort of the god of tax and you protect that position. Allow people to provide input into the function. Then analysis risk. Well, that comes with the ability to analyze. Very few people have the ability to apply systems thinking to analyzing problems and coming to solutions. Very technical people very often do not do that except at the very technical level. So analysis risk is firstly the factual analysis risk. So I've looked at the facts, but I've misinterpreted that. So recently we've seen a number of court cases, for example, where SARS took a different view on what the nature of the supply is, as opposed to what we looked at as tax people. Now, that is just a disagreement. We disagree on what the facts are, but the reality is we need to be cognizant of the way the world looks at something and not what we think it is. And then technical analysis risk. Once we have all that information, are we in a position to ultimately deal with what all the information that has come our way? And you may recall that we've previously talked about the issue of don't overanalyze, don't fall into the analysis paralysis pitfall. Ultimately, at the stage, you have to make a call. The only call you have to make is based on the best information you have available at that time, and you keep your records. This is why I've made that call. That should protect you against future imposition of penalties, not interest, but penalties, normal penalties, and understatement penalties. Provide a platform from which you can defend yourself, but don't provide a fortress. There are no more fortresses available in the field of that we're operating in this maze of changes all the time. So just be comfortable that what you have is enough, and then go with that. And then follow-up risks. This is a huge issue. More and more we see tax people being used in large organizations, but it's one or two resources. It is not possible to follow up things. So all the information flows in, but it's such an overflow that you can't follow up. And then we know the problem is there, and then you can't defend yourself because you knew the problem was there, but you simply did not have the time to follow up, and sometimes also not the technical ability to follow it up. That's also a management issue that need to be considered. But with this comes the issue of automation. And if the better the system, where a simple issue that comes to your attention can automatically be assigned to a party that should be dealing with. This person claimed input tax on the year-end function. Should we have claimed it? Come, you shouldn't worry about that. Send it to the person that deals with that minute or low-level stuff. And you only deal as tax manager with the critical issues. But the importance, now we're getting back to the principle of communication and policies and procedures. All of that should be contained in the policy procedure, and when that thing ends up in your desk, which is not the tax manager, you must deal with that, and you must deal with that within a reasonable time, and the reasonable time is 24 hours. Then everybody knows what should be done. But the lack of that structure is what causes follow-up risk to become a major issue in your organizations. Okay. How do we mediate these risks? As we said before, strategic alliance. You absolutely have to align the functions in the organization. There can't be gatekeepers. There can't be people that see this is my function, nobody touches it. The moment you have that, you've got problems. Proper accounting and reporting strategies. We've talked enough about that. Tax compliance strategies, automation and technology integration strategies, and organization and resources. So those are all the things we talked about on the left-hand side of that graph we had. Remember, we looked at just now, the slide. Those are the things that if you then sit back and say, I've got all those things in place, you can't expect anything more of me. If something still slips through the cracks, and it will from time to time, then we deal with it. But hopefully there will be some measure that will pick that up before it becomes too big an issue. So this is just the framework for a tax manager. How do I deal with a risk in my organization? How do I look at it? How should my perceptions of risk change when I look at my organization? In the next session, we will be looking at specific tools. How do you measure risk? How do you set it into a risk map ultimately, where you can demonstrate? I've considered this. For example, if have you registered as a VAT vendor? And a larger corp, yes, we are registered. That's not an issue at all. But it might be an issue that we have certain joint ventures that should be separately registered. Understand your business. But normally registration is not an issue at all. So those are the things that we'll be talking through, and we'll give you an example of a roadmap, and also of how do you summarize that roadmap so that you can look at this thing and say, how do I use this tool so the main thing remains the main thing based on my understanding of the default position in this organization without over-analyzing. See, I've just summarized the entire previous session. Okay, guys, so we'll soon issue the next session. You are most welcome to use these videos in your own organizations without our approval. And if there's value in it, let us know. But we're not going to ask you to pay for that. But if there's value in this discussion, let us know. So the next session will also come out shortly. We're going to try and put 2 of these out a week for the next few weeks, and then you'll have the entire program at your disposal. We're just not giving away the book that goes with it. If you want that, then you can let us know. Okay, so until the next session, hopefully we'll see you there. But for now, it's me, Chris Oteron, checking out for Tradetaxplus Management Services.